Okay. Yes, is it visible? Yes. Are you able to hear me?
Yes, sir.
Shall I continue? Start. So this is 2019 paper. Explain bookkeeping and accounting. Short note. What is journal? Explain the purpose. How interest on capital is treated in final account given in adjustment. See, while explaining the adjustment, I said one can expect short note on adjustment. So the interest on capital, it should be calculated on capital, and it should be shown on debit side of the profit and loss account, and secondly added to capital on liability side of balance sheet. And business entity concept. Then money market, primary market are two. Third unit, payback period, internal rate of return, asked in the internal question. Then turnover ratio and internal intercoverage ratio both are from fifth unit. The long question, write 3 accounting conventions, journal entries, and final account. So again, it may be the same question pattern. You may find 15 marks. Um, then in this paper, see from first unit, I got 3 questions. Petty cash book, last question, but one, prepare 3 column cash book. And 15th is related to ratios. 14th is net present value. 13th is draw the structure of Indian financial system. Role of intermediaries. Role of financial intermediaries to explain. So if you are thorough in first unit, so if it is 3 question, 2 or 3 you will find. If it is 3, then it's more advantages. If it is 2, then also it is okay. Okay, we will see this final account. So just I will spell where it appear. Before that you spell yourself, then you correct yourself whether it is correct or wrong. Land and building. Land and building. Asset. Advertisement expenses. Profit and loss account. Machinery. Asset. Carriage. So here no suffix on purchase or on sales or inward, outward, then in trading account. If it is on purchase or we call it as inward, then it is trading account. On sales or outward, then profit and loss account. So here nothing is there, then it is trading account. Furniture, asset, interest, profit and loss account. Salaries, profit and loss account. Trade expenses, profit and loss account. Wages, trading account. Opening stock, trading account. Bad debts, profit and loss account. Debtors, asset. Cash, asset. Cash at bank, asset. Purchases, trading account. Then coming to credit side, capital, liability, creditors, liability, bills payable, liability, sales, trading account, loan, liability. Then coming to adjustment, closing stock, trading account credit side, asset side of balance sheet. Outstanding wages added to wages in trading account debit side and liability side of balance sheet. Then depreciation on machinery. So on machinery we have to calculate 8,25,000, 10% means 82,500 shown on debit side of profit and loss account. And from in asset side, from 825 you have to subtract 82,500. The balance should be shown in asset side of balance sheet. Prepaid salaries. Salaries paid in advance. From salaries it will be subtracted in profit and loss account debit side. And we'll show this one on asset side of balance sheet. Yes, clear? Any doubt? So trading and profit and loss account for the year ended so and so. So the debit, credit. So debit side in trading account, first we will write opening stock, purchases. From purchases you have to subtract sub purchase return. I said it is mandatory, just you write down. If it is not given, put hyphen or zero. Similarly, credit side sales, from sales you have to subtract sales return. Then carriage, then wages. On this there is an adjustment, outstanding wages added. Then adjustment, closing stock, credit side. Then we have to balance. So the credit side is more, debit side is less. The difference is gross profit. 3,71,000 is gross profit. So this will be transferred to next account, that is profit and loss account. So gross profit transferred from trading account. So the same 3,71,000. Then in debit side, first we will start with salaries. And there is an adjustment on salaries, prepaid. So subtract, minus. Then interest, bad debts, advertisement. Then from adjustment, depreciation on machinery. So on 8,25,000, 10% it comes to 82,500. So here also the credit side it is more, the debit side is less. The difference is 2,20,500. That is net profit. Net profit. Then we have to prepare balance sheet as on no debit and credit, liabilities, assets. So liability side, first you will write capital. If any drawings, you will subtract the net profit, what we earn, that will be added. Then the credit balances remaining, loan, bills payable, creditors, then the adjustment, outstanding, wages. The debit side remaining balance, land and building, machinery. On this, there is an adjustment. We subtract that depreciation, then the balance will be shown in outer column. Furniture, debtors, cash, cash at bank, stock from adjustment. Okay, thank you for remaining in the class. Are you able to hear me?
Yes, sir.
Okay, we'll continue. So in balance sheet, land and building, from machinery we have to subtract the depreciation. Then we have to show the remaining amount. Furniture, debtors, cash, and cash at bank. Then from adjustment, closing stock, prepaid, salaries. Here outstanding salaries. So the five adjustments, four I think. Outstanding wages, closing stock, prepaid, salaries. The depreciation is subtracted from concerned asset, that machinery. So this is final account. Hope it is clear. Having any doubt, you may raise. Any doubt? Shall we start new topic? Hmm? The fifth unit, continuation to this. See, if you are not responding, then I don't know whether you are listening or not. Huh? Are you able to follow or not? Unable to know anything. So the ratio analysis, the next unit, fifth unit is ratio analysis. So in this, the continuation to the second unit, the second unit is the result of the financial year end. And now you have to interpret the result. Why, how, then what to do for further future course of action. For that, you have to interpret that information, data. So that is the relationship between two variables. By taking that result, you are going to interpret and decide the course of future action. So that is ratio analysis. So now this is very simple. Just if you know the variables, then you are able to find out that ratios. So the materials are available in my blog. So the classification of ratios, so it may be in traditional or functional classifications. Functional classification or traditional. So the traditional classification, statement of profit and loss ratios. So first ratio is basing on the information from profit and loss. So profit and loss means the revenue statements combinedly, trading and profit and loss account, if it is a trading organization. If it is a manufacturing organization, manufacturing, trading and profit and loss account. If it is service organization, only the profit and loss account, revenue account, we call it as income statement. Income statement. So that the relationship between the some variables you will study within that statement. Then the balance sheet. Then the balance sheet ratios. Then the balance sheet ratios. So the information you will take from the balance sheet and you will find out. So in case of profit and loss account ratios, the relationship between profit and sales, profit and expenses, operating expenses, non-operating expenses, the relationship between gross profit and sales. So what is the ratio? Gross profit to sales, net profit to sales. That is, then in balance sheet ratios, you will find the relationship between your assets and liabilities. owner's investment and liability, owner's investment and asset, like that. Then the third one is, so that is balance sheet ratio. So you will take the variables within the balance sheet. So that is balance sheet ratios. You will take the variables within the revenue statement, that is profit and loss account ratios. Then composite ratios. We will take the variables from both, either one from profit and loss account, another one is from balance sheet. So there is composite ratios. So traditional classification is statement of profit or loss state ratios, balance sheet ratios, and composite ratios. Then if we have taken this on functional basis, so the profit and loss ratio. So from profit and loss, you wanted to know what is my gross profit ratio. On sales, what is my gross profit ratio? Then you are able to compare with the previous year gross profit ratio, or you are able to compare with the similar type of entity in that industry. So whether we are doing well or not, so then why we are lagging back. So you are able to find out all those. So that gross profit ratio, operating ratio, that operating expenses, profit on operating expenses. Then operating profit ratio, operating profit ratio, net profit ratio, net profit ratio, return on investment ratio. So how much we invested the capital. So how much the return we earned. So all these are profitability ratios, are profit related to profit. Then the activity based ratios, activity, turnover, turnover means one cycle, completion of one cycle. See, we purchase the goods, that purchased goods will be on credit, means creditors. Then you will sell the goods on credit, then debtors. From them you will receive cash. Then that cash will be paid to creditors. Again you will purchase the goods. Again you will sell the goods. Again they will become debtors. From them you will collect. So this is one cycle. How many number of cycles we completed? So if we completed more number of cycle, then there is more scope of profit. If there is less number of cycle, then there is less profit. If it is in a production organization, purchase of raw material, conversion of raw material into finished goods, in between we will find work in process, then you will have finished goods, that finished goods will be sold, again you will realize the cash, again raw material. So this is one cycle. How many production cycles we completed? How many production cycle we completed? So this is activity. And in case of same sales on credit, debtors, you will receive cash, again sold, and again debtor, again. So this is debtors turnover. Turnover, how many turn it is over, that is turnover. Similarly, purchases on credit, purchase, so you will become creditor, you will pay cash, again you will purchase. So one cycle is completed. So how many times we purchased and how many times we paid the cash. So that is turnover. So all comes under activity ratio, turnover ratio. So in that, inventory turnover ratio, first one. Inventory means purchase. So if it is trading, so you will have only the only the stock, that is stock, only we will call it as stock. If it is production, then you will find raw material, work in process, progress or process, and finished goods. So the stock will be of three types. So, so if it is a production, if it is trading, then we will have only finished goods. So how many times we purchased and converted them into finished goods and sold, and again, so that is one cycle. So how many number of times we did, so that efficiency it solves, it says your efficiency of selling your product. So that is inventory turnover ratio, inventory turnover ratio. Then, so this is inventory turnover ratio. Then trade receivable turnover ratio. So we sold goods on credit. So that is sales. We made sales on credit. So then he became debtor and we will receive cash. So how many number, again you will sales and he will become debtor. Again you will cash. After receiving the cash, again you will sold. So this is one term, one cycle. So like this, how many number of times we sold. So that is trade receivable. So this receivable means debtors. So this debtor, he may become a debtor because I lend him or had given advance. So then it is called other than trade debtors. If he sold the goods on credit, then he owed to me, then he is called trade debtor. So trade debtor means he liable to the firm, he owed to the firm, he due to the firm because he purchased goods from us on credit. So he became a trade debtor. So that is trade debtors or trade receivables turnover ratio. So here we will include debtors plus bills receivable. Collectively we call it as receivables. So that indicates the turnover of bills receivable. That is receivable turnover ratio. Similarly, payable. So we purchased goods and we owe to the supplier. He become creditors and we pay cash or bills payable. Either it may be a cash or bills payable. So if it is cash, it is settled immediately. If it is bills payable, on due date, he will deposit that into the bank and from bank it will be settled. So this is one cycle. So again, the trade creditors. So whenever we purchased goods on credit, he became a creditor. Then only we called him as a trade creditors. Then the other dues are other than trade creditors. So we will consider only trade creditors. In the question, if the had given trade creditors other than trade creditors, we will consider only trade creditors for creditors turnover ratio. If nothing is given, we will treat all our trade creditors only. Then working capital turnover ratio. So the working capital is production. Purchase the raw material, work in progress, converted into finished goods, sales. So this is one cycle over. Again, you will purchase the raw material. So this is how many number of times production cycle is taken place. So these are all the example for activity ratio. Activity ratio. Then solvency. Solvent means financially sound. Insolvent means he is not financially sound. He is not financially strong. We call him as an insolvent, bankrupt, diwala. So when his assets are not sufficient to meet his liability, so then we call it as insolvency. You are not in a position to pay your dues. So then you will become liable. Then the situation forces you to take a degree of insolvency. So that is insolvency. So that solvency ratio. So the solvency means how much possibility of paying your dues. If it is possible to pay your dues, then you are solvent. If your possibility is not so good, then so always our asset should be double the liability. So if you owe to outsiders 1 lakh means you should have 2 lakhs. So then you are financially sound. Otherwise it is not. So this solvency ratios, debt equity ratio. So debt and equity, how much investment you are having, how much debt. Total assets to debt ratio, total assets to debt ratio, proprietary ratio. So all these are the ratios reveals the financial stability of the organization. To know the financial stability, we will know this. The last one is liquidity ratio. Liquid means hard cash or which can be converted into cash easily. Which can be converted into cash easily, then we call it as a liquid asset. So that liquidity situation, position, if you are able to pay your expenses, daily expenses easily, then it is you are having sufficient funds meet your day-to-day activity. So that to know that one, this ratio will be calculated. That is liquidity ratio. So the current assets ratio and quick ratio, current assets ratio and quick ratio. So these are all the another form of presentation basing on their activity. This is on the basis of traditional. So one by one we are going to see the ratios. So the first one, liquidity ratios. Under liquidity ratio, first one is current ratio. So the liquidity ratio means it gives a picture how much sound we are, how much strong we are in paying, able to meet the day-to-day expenses, meet the day-to-day expenses. So that is current ratio, current assets by current liability, current assets by current liability. Now one should know what is current asset, current liability. So current assets includes, so not in a position to make, okay. Current assets includes, so if it is for example, cash in hand, cash at bank, inventory. If it is ordinary trading, then you will have only stock. If it is production, raw material, work in progress, and finished goods, three form of stocks will have that goods. Then debtors. If debtors, again, already said in the class, earlier classes, that is debtors are three types: good, bad, doubtful. So if good debts, direct you will take. Simply debtors are given and provision for bad debts or bad debts are given, then it should be subtracted. Then bills receivable, short-term investment. So for within 1 year, if you are able to realize that amount, then it is current asset. And prepaid expenses, accrued income, income earned but not received, expenses paid in advance, tax paid in advance, or any short-term loans given to employees and others. So that comes under current assets. So you have to take this information if it is given in the question or in balance sheet, and adding all this, you will get the sum of this is current asset. Then current liability. Current liability, creditors, current liability, creditors, bills payable, outstanding expenses, bank overdraft, cash credit, accrued expenses means similar to outstanding, provision for taxation, and proposed dividend or unclaimed dividend, and if any income received in advance. And the short-term borrowings, if it is less than 1 year, if anything is borrowed for a period of less than 1 year, then that will be current asset. If it is for more than 1 year, then it will be a long-term asset. Loans and advances from banks and other lenders. So if if any information related to this is given in the balance sheet, we will add the sum up. The sum of this is current liability. So current assets by current liability, you will get ratio. So the ideal ratio is 2:1. So if consider that entity organization is good, liquidity position of the organization is fine. For that, we have to see whether their liquidity, the ratio is 2:1. Assets, current assets are 2 and liability is 1. Then the current liquidity position is good. Now, See an example. See, you may find the question like this, or they may give the balance sheet. Plant and machinery is asset. Short-term investment is current asset. Debentures means loan. See, whenever you raise the loan from the bank and financial institution, you will call it as a loan, term loan. If we raised that loan from public, if we raise that loan from public, then we call it as a debentures. Then we call it as a debentures. So this is also long-term loan. So sundry debtors, current asset, outstanding rent, current liability, prepaid insurance, current asset, stock, current asset, bills payable, current liability, sundry creditors, current liability, and cash at the bank, current asset. Now, so current assets, short-term investments, debtors, prepaid, insurance, stock, cash at bank. The sum of this is 5 lakhs. Then current liabilities, outstanding rent, bills payable, creditors, or current liability. Sum of this is 2,50,000. So current assets 5 lakh, current liability 2,50,000. So the ratio is 2:1. So the financial position of the firm is good. So very simple. So for this you will get 5 marks, or they give 2 or 3 ratios. So 2.5 marks. If it is 2, 3 ratios are asked, 4 ratios are asked. So for this, for this current ratio, you will get 2.5 mark. Or only 2 ratios are asked, then this carries 5 marks. Very simple. The thing you have to remember, what are the current assets, what are the current liability. Similar question, next one. So inventory is current asset. Loose tools also current assets. Loose tools means the instruments which are used for testing and other things. So the life of the tools will be very less, and we are not able to find out the value of the tools. So again, you will find what are the tools are available, good in good position. The value of that asset is that much at that current situation. So it is also a current asset. Tools, loose tools, spanner, and the testing instruments all comes under loose tools. Long-term borrowings, short-term borrowings. You have to consider short-term borrowings. Trade payables, trade receivable. Trade payables, current liability. Trade receivable, current asset. Short-term investment, current asset. Cash and cash equivalents, current assets. Okay. Now, by adding all this, see, inventories, trade receivables, short-term investment, cash and cash equivalents, loose tools. So the total of that is 6,80,000. Then current liabilities, short-term borrowings, trade payables, 330, 3,30,000. So 680 by 330, 2.06 is to 1. So the financial position of the organization is good. Then in this, see, before going to spell myself, you tell yourself it's a current assets or current liability. Sundry creditors, current liability. Sundry debtors, current assets. Bills payable, current liability. Bills receivable, current assets. Short-term loans from bank, current liability. Long term is long term, non-current is non-current. Public deposit for 1 year. Public deposit for 1 year, current liability. More than 1 year, non-current. Non-current investments, he himself says. Current investment, he himself declared that. Current investment is current asset. Short-term loans to employees, current assets. We had given. Closing stock, current assets. Cash in hand, current asset. Cash at bank, current assets. Checks in hand, current assets. Okay. Now the answer. Bills receivable, current investment, debtors, short-term loans to employees, closing stock, cash in hand, cash at bank, checks in hand. So the sum of this 7,65,000. Current liabilities, creditors, bills payable, short-term loans from bank, public deposit for 1 year. So the ratio is 1.8 is to 1. So it's not so strong. So okay, near about. So this is about the current ratio. Any doubt? Is it clear? It's very easy. Just you have to remember current assets. What are the current assets? What are the current liability? So all this material I posted in my blog. Just you go through. If having any further, then in next class you may put a message. I will update if anything you want more than that. I will take the attendance. Wait. So meanwhile, if you are having any doubt, you may raise.